She is the 25th chair of the Council of Economic Advisors for the President, the Wilson Professor at Berkeley. Christina Romer, good morning.
Good morning.
Much to talk about here, 9.7%, a mixed report. You're one of the nation's experts on political economics. Right now, are we more political or are we more economics?
Well, I think what certainly in my current job need to be thinking about what's right for the economy, and we are focusing on that 100%. And I think we are starting to see some of those dividends paying off.
What did you see in the report today that's beginning to pay off? I saw 9.7%.
Well, absolutely, 9.7% is a tragedy, and that is, there are millions of Americans that are unemployed. I think the important thing to realize that was largely anticipated, that we know as long as we're losing jobs, that unemployment rate is going to go up. That really emphasizes why it's so important that we stop losing jobs and start adding them, and that's sort of the trajectory that we're seeing. Remember back in January, we lost over 700,000 jobs a month. This month we lost 216. It's a terrible number, but it's the smallest we've seen since the collapse of Lehman Brothers last September.
Well, when do jobs start getting added to the economy? What's your best guess?
Well, what we've always said is typically the labor market lags behind the rest of the economy. So we're first going to have to see positive GDP growth, the overall economy expanding. I think when we see that happen, we'll start to see jobs maybe a quarter or two after that. Right now, what I'm encouraged about is most of the private forecasters are saying, boy, when they look at the third quarter of this year, they're cautiously optimistic that we are going to see some seriously positive GDP growth.
Okay, so right now, as we speak, the numbers are starting to turn up.
They are, absolutely. I'd say, over the last couple of weeks, we've just gotten a number of positive economic indicators. We saw, for example, the purchasing managers telling us for the first time manufacturing is actually expanding. We saw some data that said consumers were actually coming back a little bit. We saw personal consumption expenditures go up. We saw durable goods orders. That's a sign that people are starting to invest again, put in place orders for machinery and equipment. All of that is an encouraging sign, and I think that's what a lot of the private forecasters are seeing.
Professor Romer, coming out of your work at William & Mary a number of years ago, in your study of economic history, how much of the angst that Americans are feeling is structural unemployment angst, or is it cyclical unemployment angst? How do you tilt that right now?
Well, I think, what the American people are certainly feeling is just, what a terrible recession we have been through, again, since the financial crisis really began in seriousness last September. So that is certainly what they're feeling. What we're going through is unquestionably a cycle that we are, we have just simply seen GDP plummet, we've seen investment plummet, we've seen consumption plummet. All of those things are consistent with a very severe short-run economic downturn.
Just in the 1 minute we have left with you, Professor Romer, what is your single message, your first message to the President tomorrow morning? What is the Romer message right now?
It's thank heavens we put in place the actions that we did in the beginning part of this year. They are absolutely paying dividends, and the most important thing we can do is stick with them because they are absolutely helping to turn this economy around.
Would you support another stimulus?
At this point, we are very encouraged that the stimulus we've put in place is doing its job. Of course, we're going to be watching this thing. The important thing, as we've talked about, is not only turning the corner, but really seeing the kind of robust GDP growth that will finally add jobs and bring the unemployment rate down.
Christina Romer of Berkeley. She is the chair of the President's Council of Economic Advisors. Thank you so much.